Hey everybody, this is Dr. Flight. Hope you are doing great. We're going to spend some time today looking at analyzing the pricing situation. So basically the deal is, as you are going through regular business operations, one of the things we want to do is be consistent in evaluating what our pricing strategy is and how effective the pricing strategy is given the goals and objectives we have as the firm. So basically what we're talking about is setting up a system by which we analyze our current pricing situation, and we dictate and determine whether our current plan and strategy is working out. So there's four key pieces here that we want to think about. If I'm going to analyze my price situation, I want to, one, look at my and consider my pricing objectives, think about the market, and in particular, we look at customer price sensitivity. We look at our cost structure that we have internally in order to produce our product. And then we think about from even a game, like a game theory type of perspective, what our competitors are very likely to do as we move forward. Okay, so again, we want to just kind of walk through these four pieces, and they will help like evaluate and determine whether our pricing situation, what our pricing situation is, and if our strategies moving forward are currently appropriate. So when we think about pricing objectives, which is our first piece of the puzzle here, there are three or four or five different objectives that we typically think about when we identify like what we want our pricing strategy to do for us. One of which is we want pricing to play a role in how we position our product relative to our competition. So again, we think of perceptual maps sometimes as a tool to be able to do this with. We want to think about how the pricing elements that we offer correspond with other marketing mix pieces as well. So the positioning of the product then is something we want to think about as we price. We also use pricing for a lot of different objectives here too. So we want to increase demand for our product. So if we want to increase sales, for instance, we'll use pricing tactics, either lowering our price or maybe doing a promotion of some type in order to stimulate demand for our products and increase sales. We also sometimes use price to move or force our competition into some type of behavior that they otherwise may not want to participate in. So if we lower our price, for instance, by lowering our price, we're probably going to increase sales and probably increase market share, which will impact our competitors. And so the next question is, well, what will our competitors do? They're probably going to change their price in order to either match ours or take some other type of strategic position. So certainly we can think about how we want to manipulate our competitors as a result of the pricing, tactics that we use. Other objectives, gaining market position. So again, if we want to boost our market share or we want to show ourselves as a leader or we want to be aggressive somehow in the marketplace, we can manipulate price that way. And then finally, we have pricing objectives that are based on financial performance within the firm. So again, this is like actually a really big objective, and a lot of managers across the firm will say, well, how can we make more money? How can we gain profit and can we manage our price better in order to do that? So the financial performance of the organization may come under scrutiny, and we may use pricing tactics specifically to try to reach some of those goals that we have. So the first step then of analyzing your pricing situation is to kind of internally think about how we want to price, what's our pricing philosophy going to be, what objectives do we want to accomplish as a result of our pricing strategy. So that's step number one. Step number two is to think about customer price sensitivity. And so a lot of times we think about this as a relationship between the price we charge and the number of sales we'll accomplish based on that price. And if we were to change price, how how much or to what degree would sales also change? So we think about the rate of change in sales as a measure of sensitivity as we change price. And so this is where the concept of elasticity comes into play. Many consumers and industry factors contribute to price sensitivity um, based on demand given. So what our competitors are doing, the quality of our product, consumers' disposable income, whether this product is a luxury good or a necessity or a luxury type of a product, and so forth. So price sensitivity then is something that we can use in a lot of different ways in a lot of different areas. And again, we measure this oftentimes by what we call price elasticity. And so the elasticity function here, and you can pause this if you want to write this down or think about this more. It's basically when we think of the percent change in quantity demanded, which would be this top part here, divided by the percent change in price. And when we get the percent change in quantity demanded divided by the percent change in price, then we have a ratio, if you will, or a rate in which products or in which the market demand changes whenever we change price. Remember, we have these concepts called elasticity, like elastic, inelastic, and then we have unitary elasticity, and it's based on this measure, this E that we calculated below here being greater than 1, less than 1, or even equal to 1. Okay, so review those notes. This is something that you've had before, elasticity of demand. But note some special elements here. Demand is more elastic when customers care less or are not as involved with the product purchase, or they don't have strong preferences, in other words. Items, if an item is a luxury good rather than a necessity, they'll tend to be more elastic. When there are lots of substitutes available, when the purchase is large and there's a lot of switching opportunity involved, then then people will be more elastic. When the household incomes are lower, in other words, the purchase is relatively more important or higher for the household, and when it's easier to compare prices. So here's the deal. When the market is elastic, generally speaking, they're more price sensitive. So the smaller the price change, the larger the change in demand. Remember, the smaller the price change, the larger the change in demand. So you got to be very careful here when we deal with price changes and elastic environments. Lowering your price may or may not increase, it'll increase sales, but it may or may not increase your profit margin. And so anyways, you just got to be a little careful here. Customers are more willing to switch to a competitor in this type of an environment. When we talk about inelastic environments, this isn't so much the case. Customers will be less likely to switch to you or from you based on a pricing change. So typically demand is more inelastic with increased customer desire. So in other words, I can raise price and customers will still buy my product, and fluctuations in price will be greater than fluctuations in demand in an inelastic situation. So when your product is perceived as better, when there's more brand loyalty, when you have greater brand equity, if competitors' brands simply aren't as favorable, if there are fewer good substitutes, or if the substitutes are priced higher, then people will be much more likely, customers are likely to not switch given price changes. So that's an inelastic situation. In the inelastic situation, you'd be encouraged to raise your price and reach a point where you're increasing your price and you will increase profit overall. So graphically, if we look at what these might represent, we have an inelastic or a brand loyal market which is represented by this demand curve. And then we also have a second market segment that's represented by this second curve, this deal-prone curve that's elastic. So in other words, this market, this deal-prone market, we probably need to adjust our price and we need to offer them deals in order for them to stay with us. This market here is a market that's more loyal. I don't have to price discount as much for them. I just need to continue to offer them a good product that they'd be interested in seeing. So this is a good little chart from the text, and it describes different scenarios of elasticity or inelasticity. So we have elastic measures below and inelastic above, and we have a deal where when it's inelastic, we raise price or lower price. It's kind of an option that we could do. When we raise price, our total contribution or our profit will increase. So in an inelastic environment, we typically want to raise our prices, not decrease our prices. However, in an elastic situation, it's hard to determine what will happen. So we have to do actually more analysis to better understand whether we're going to make more money or less money with a price raise or rise or decrease for elastic prices. So use caution when lowering prices. If percent margins are lower, a lower price will increase sales, but often results in lower profits. So think about that a little bit. Ponder the idea of price changes in different elastic environments. Now, there's lots of different ways we can measure elasticity or price sensitivity. We can do surveys. We can look at historical purchase data. We can do also something called a conjoint analysis as well. And again, you can kind of pause the video and look at these in a little bit of a greater effort here. So we can run experiments, and then we can like do surveys. We can ask people their likelihood to buy after a change, and we can manipulate this change here, whether it's 10%, 20%, 30%, something like that, in relation to our expected price or expected sales level. We can also do models. So we can do a model like this is a regression model, and we have price here, and then we have all these other factors that would be in our advertising mix. But this element here might give us a price sensitivity measure. So this beta here, when estimated, gives us our measure for price sensitivity if we use a regression. And again, we're collecting data and maybe watching observations and stuff. Another way we could do this is we have a sample that is split in half, and half the sample gets question 1, half the sample gets question 2. So half the question sees the price at $25, the other half sees it at $35. And typically what you'd do is you'd see like the average might be a 5-point something on this one, and the average here might be a 3-point something. And the difference between the two represents the difference in potential demand as a reflection of the change in price that we have here. So we have a change in price and a change in demand, and by doing that, we can calculate price sensitivity. So again, lots of different ways to be able to do this. Here again, please pause this if you want to. We have our two different, this is just some example data for the question we just saw. $25 price versus a $35 price. So price 1, price 2, demand 1, demand 2. We have average scores. On the higher price was 3.6, lower price was 5.3, and we can calculate this as a price sensitivity measure. So this is very elastic in this particular example. But again, please take a look at this and pause if you want a better view of how we measure price sensitivity. Okay, so step number 3 then, we need to be very concerned about cost. So in marketing, in most marketing classes, we don't spend a lot of time on cost. However, cost is a key contributor to profit margin. A lot of times we avoid talking about cost because cost is something focused more in operations and other areas of management. So not to say that we shouldn't, because we absolutely should, but we often just don't see a lot of coverage on cost as a thing to worry about, but we need to. So we need to worry about how our products costs are formed based on fixed and variable costs, and whether we can control those or not. So if you have a high overhead or high fixed cost, then it means that your contribution margin is going to have to be larger, and that you're probably going to have less ability to lower your price, if that's, in order to cover costs. So the composition of product costs refers to the percentage of variable versus fixed costs that are associated with the total cost of the product. Another idea here is the volume effect on costs. We typically understand that a higher volume of produced goods indicates a lower overall cost per unit. So that's certainly true. We usually get better deals from suppliers if we order in bulk in higher volumes. We also think of our fixed costs as going down per unit with the more products that we produce. Another idea here, also you can consider a little bit of a deviation from a volume effect, is an experience effect. The longer that you are producing goods, for the longer period of time that you're doing so, typically the more efficient you get, which helps to drive price down or cost down as well. Competitive advantage, and then control over costs are two other kind of ideas that are more, again, managerial when we think about this. And we'll look at competitive advantage here a little bit, kind of as we move forward, because we want to analyze competitors' reactions to us. But from a competitive advantage, we want to think about our cost of production relative to our competitors' cost of production, and whether we're competing in a more efficient or producing in a more efficient manner. That's a big deal, actually. When we can gain a cost advantage over our competition, then we can have a much stronger competitive position in the marketplace. We can lower our costs. We can offer the product for equal or better value at a lower price. So that's a form of competition that we can take advantage of if that's the case. Also, we think about having some type of control or leverage over our costs as well. This leverage or bargaining power that we have might be thought of as one of Porter's 5 forces. But when we think about buying from our suppliers and being able to pressure suppliers to lower their price, that's the bargaining power that we're leveraging when we think about how much control we have over pricing or costs within the product production process. Okay, so cost analysis then is the third area. So again, we looked at objectives first, and then we looked at consumers and their price sensitivity second. Now we're looking internally at our cost structure. And then the final piece of the puzzle here is being able to analyze and understand our competitors, and what our competitors will do as a result of the behavior that we're exhibiting. So competitive advantage happens when we start analyzing our competitors' cost structure too, like we just mentioned, but then using that information to form our price strategy. Now, the next step in this is to better understand this idea that for each move we make, we have to anticipate or expect that our competitors will react in some way. So think about if I lower my price, if I raise my price, if I reposition myself on a perceptual map, what will my competitors do as a result of that? And will they, in their decision-making process, alter their price because it's a key element to their strategy, or will they largely ignore us? Will they let us do what we want to do without any impact at all? What again is their probability that they will change their price if we change ours? Or moreover, what are we going to do if they do change their price? What else will we do moving forward? So part of this fourth section or fourth piece of analyzing the pricing situation, then you can incorporate games and what we call game theory to estimate the likelihood that your that your competitor will will behave in a certain way, and then what would the outcome of that behavior be? So we often kind of do these probabilistic games where we try to estimate the probability that our competitor will make a move and then what that impact will be and whether they will benefit, we will benefit, or if there'll be some type of mutual benefit that happens. Now, that may take place. Sometimes we think about a perfect game as one where everybody benefits at the end. So it may be in our advantage and our competitors' advantage to both lower price simultaneously and both gain some market advantage. Now, there is an idea that that may allude to mutual cooperation or collusion, but if both firms benefit from it, then that might be something that happens naturally, even without a kind of a formal discussion or whatnot. So let's just take a pause as we wrap this up. This is the very last piece that we'll think about here. This is a game theory box down below with different scenarios that happen here. And basically what we want to do is we currently have this idea that we have a $5 product that's out there. Our firm has a $5 product. Their firm has a $5 product. We each share the market. We each have 100 units that we sell. That's kind of the status quo. That's kind of where we are right now, where we're over here. Now, let's suppose that we each or like we cut our price or they cut their price. If we cut our price, then we're gonna gain units. We're gonna gain units, and we're actually gonna stimulate people to our product category. Before here, we had a total of 200 units sold between them and us. If I lower my price to $4 instead of 5, I'm gonna gain 200 new buyers, 50 of which are going to come from our competitors, but 150 are going to come from somewhere else because now I'm going to have 300 units sold. They'll decrease to 50 units. So they're not going to be happy about that, and they're probably going to lower their price to match ours. But what happens is when they do lower their price, so we moved from here to this box, and now we're moving up to this box. When they do lower the price, we get equilibrium again. So we both share the same number of units sold. We have the same market share, but our overall units went up, doubled from 100 units to 200 units. So this is like a game where we think about what would happen if we made a change, if they made a change. Obviously, if either they lower their price or we lower the price, the other party's going to match it. And when they do match it, we both benefit because more customers come into our product category. So before we had 200 units being produced or sold. Now we have 400 units being sold in the marketplace, and so that's an overall gain. So in this case, it's a deal where it's in both of our interests to gain market to lower price. We both gain a market presence and a sales volume by doing so. So again, this is kind of analyzing the competition. And so just as a wrap up again, we had 4 different ideas here to analyze our price situation. We think about why we are pricing, our objectives. We look at our customers, customer base, price sensitivity, product costs internally, which alludes to product sales margin and profit margin. And then a real fun area of pricing actually deals with game theory and competitor responses. Okay, so again, this is a review of the pricing situation. If you have any questions, please reach out. Look forward to talking to you. Please have a great day. And again, reach out to me if you have any questions. Thanks.